Hello and welcome. This is our first international trade news broadcast. While we do deep dives into different international trade related topics, the world events don't wait and there is much going on. Global shipping costs, for example, have surged to record highs due to a combination of war and extreme weather, impacting key global choke points. Threat of attacks in the Red Sea and near the Strait of Hormuz has forced tankers to reroute, driving oil freight rates from the Gulf to Asia to an all-time high of about $15 per barrel. Moving crude oil from the Middle East to Asia typically cost under $1 to $2 per barrel during the non-crisis baseline periods. This was in late 2023 to mid-2024, as well as during low-demand periods such as the mid-2020 and 2021. Shipping in other regions of the world is also affected, but the highest prices are observed in the Middle East to Asia routes. In this context, air freight is experiencing strong demand and spillover volume for ocean delays, particularly on high-value electronics and automotive parts. Rates remain about 30 to 50% higher than historical pre-pandemic baselines. Rail and overland drayage, which is mostly associated to domestic transport costs, are seeing added charges at key hub ports such as LA, Long Beach, Hamburg, and Rotterdam. There are also port congestion surcharges during peak periods. As matters usually go, these costs are expected to be passed on to the consumer. But surge in shipping and energy costs is projected to generate near record profits for major oil companies in the second quarter of 2026. Global goods trade reached roughly 13.7 trillion in the first half of 2026, which is up 12.5% year on year. Much of this growth is value inflated by high energy and shipping costs rather than actual volumes increases. The EU has a new packaging regulation called Packaging and Packaging Waste Regulation, short for PPWR, where binding compliance deadlines took effect on August 12th, impacting global exporters. PPWR mandates strict limits on heavy metals, bans PFAs in food contact materials, and caps empty space in shipping to 50%, requiring exporters to re-engineer packaging chemistry and implement automated minimal packaging solutions. These regulations, which include mandatory lab testing and impose penalties for non-compliance, are driving an industry shift toward more sustainable, double packaging-free designs, which overall is not terrible news, other than for the fact that this will create quite a lot of work for different packaging manufacturers and suppliers, etc. This new legislation will fundamentally affect all different businesses abroad dealing and trading with the EU, whether it be directly or indirectly, because there are quite a few compliance points that need to be looked at. The mechanism that enforces this policy, called Extended Producer Responsibility, EPR for short, requires whoever introduces packaged goods into an EU country to pay eco contributions towards the collection, sorting, and recycling of that packaging waste. I will be doing a deep dive on this regulation, so please stay tuned for additional information. There was also a new customs charge entering into force in July. EU has ended the de minimis exemption where imports under €150 were not charged import duty. Now that the policy is in force for about 1.5 months, importers are reporting discontent with the €3 charge per line item and questioning the actual policy, questioning why a certain set figure wasn't applied to each parcel instead. They are also concerned with the returned parcels where the fee applied on import is non-refundable. The enforcement of this new rule seems to be currently highly inconsistent because the 27 member states apply the new €3 flat fee unevenly, with some ports using seamless automated screening while others suffer from manual backlogs. This fragmentation allows freight forwarders to exploit weaker entry hubs, which is also known as port shopping, and leaves consumers facing unpredictable doorstep delivery charges and varied carrier handling fees. Nonetheless, some international sellers seem to be adapting to this new policy by shifting their strategy toward bulk B2B shipping into the European warehouses to avoid these costly processing bottlenecks altogether. In the meantime, there are of course different countries around the world that are not happy with these EU policies. For example, the EU rejected US demands to renegotiate certain environmental regulations, reinforcing its green import standards despite broader trade friction. These regulations are generally related to the Corporate Sustainability Due Diligence Directive, CSDD, Corporate Sustainability Reporting Directive, CSRD, both of which mandate corporate reporting on the environmental impact, and a few other points as well. There is also the Carbon Border Adjustment Mechanism, that is essentially a green tax on imports. I did a deep dive into CBAM in one of my recent videos. This policy affects the biggest importers in specific sectors, so please check it out if you would like to find out more. And of course, then there's also the EU Deforestation Regulation, EUDR, that prohibits imports of commodities like soy, timber, coffee, and palm oil without geolocation data proving the products were not grown on recently deforested land. Then, as always, the EU-China trade tensions, where calls are growing for the EU to impose tariffs on Chinese hybrid vehicles because they are being used as a counter to the high import duties on Chinese electric vehicles that go as high as 45%. German car makers in particular cite distortion of competition due to Chinese subsidies. The UK, in its post-Brexit frenzy, it's slowly but surely re-establishing itself as a major power. One of such events was related to Ethiopia achieving a key milestone in its long journey to join the WTO by signing a bilateral market access agreement with the UK. The UK is currently the 10th WTO member to sign such an accord with Ethiopia. Ethiopia holds very interesting opportunities to the UK related to agricultural sector, regional presence in Africa, and therefore UK's influence in African continent. There are also many interests towards privatization of Ethiopia's telecom, banking, and logistics sectors, where the UK is expected to inject British corporate investment into these high-growth, high-profit areas. The UK and the EU also provisionally brought into force a long-awaited agreement defining Gibraltar's post-Brexit trade, border, and also customs relationship with the EU. In the last couple of months, the UK has also concluded a landmark free trade agreement with the Gulf Cooperation Council, GCC, encompassing Saudi Arabia, United Arab Emirates, Qatar, Kuwait, Bahrain, and Oman. Total UK GCC trade is currently worth 53 billion annually. The deal is estimated to boost the UK economy by 3.7 billion per year, increase real wages by 1.9 billion annually, and lift bilateral trade by 19.8% in the long run. Additionally, following the broader US trade measures and import tariffs, the UK government has also been negotiating targeted sector-by-sector carve-outs to protect key exports to the US in pharmaceutical and automotive industries. Now to the US, where high-stakes US-Canada trade negotiation collapsed on the 21st of August without an agreement, resulting in immediate 50% US tariffs on tens of billions of dollars worth of Canadian exports. In response, Canada suspended talks and announced matching dollar-for-dollar retaliatory tariffs on American goods. While the talks were going on, it was expected that the agreement would reduce the US tariffs on Canadian automobiles from 25% to 15% and slash steel and aluminium tariffs in half. They're currently set at 50%. In return, Canada would end its boycott of US liquor and relax restrictions on US dairy imports. There were also talks of potential revival of the Keystone XL pipeline. This pipeline project initially appeared around 2008, but Obama and Biden didn't like it so much. But both Trump administrations seemed quite keen to see it realized, even though such huge investment would hold many financial potential risks as Venezuelan oil is currently re-entering the US market as a competition to the Canadian oil. And also this project is very judged for its environmental concerns and impact on local communities. Furthermore, the US beef industry is navigating a tight domestic supply environment driven by a shrinking national cattle herd, which hit historic 75-year lows due to drought and elevated input costs. This is pushing grocery ground beef prices to record highs and causing some meat packing plants to close. To combat this grocery inflation, the US government took major action last week by temporarily waiving out-of-quota tariffs on up to 300,000 metric tons of imported ground beef for 90 days, aiming to cut retail ground beef prices by about 25%. Brazil and the US are currently also holding talks with Chinese supervision at WTO levels regarding additional US tariffs on Brazilian products following a formal complaint from Brazil. India amended trade policies to ease exporter invoicing in Indian rupees, promoting currency internationalization and reducing its reliance on the US dollar. Vietnam is also getting ready for US tariffs and has urged its domestic businesses to integrate advanced supply chain tracking technology and maintain rigorous origin documentation to ensure compliance with US customs audits and mitigate the impact of new American tariffs.